Is there a way for you to perhaps borrow money from your IRA and not pay any taxes or any penalty for doing so? Well, we're going to talk about this little loophole that you might want to know about in today's Tuesday tip, so stay locked in. Hi, my name is Carson Graves, certified financial planner and president and CEO of the Retirement Education Center, and I want to welcome you once again to our Tuesday tips, where today we are going to be discussing a little provision known as an IRA 60-day rollover. Now, I'm sure that many people out there are not really aware of this particular provision when it comes to an IRA. Most people, when they are talking about taking money from an IRA, they usually understand that when you do so, it can come with an early withdrawal penalty, and you may also have to pay taxes on those dollars as well. Now, most people are aware that you can borrow money as a loan from a 401k, but you cannot technically borrow money from an IRA. So this IRA 60-day loan provision may be a benefit to people who may perhaps need a short-term loan to take care of a couple of things, but may not have the funds to do so. So in today's Tuesday tip, we are going to be discussing the mechanics of this IRA 60-day penalty-free and interest-free loan. So let's go ahead and jump into our lesson. So what exactly is a 60-day rollover? So we need to understand this first and foremost. When it comes to a 60-day rollover, it's simply when you take a distribution from an IRA or a retirement plan and it's paid directly to you. Now, you do have from that moment when it's paid directly to you 60 days to deposit all or part of that money back into another IRA or qualified plan. And if not, you could end up having to pay taxes and an early distribution penalty of 10% on those funds that you did not deposit back into that IRA within 60 days. So let's go ahead and take an example of what this may look like. Let's just say that you had a $100,000 distribution from your traditional IRA. You took that as a distribution and it came directly to you. Now, let's just also say you had the custodian withhold 10% for taxes from that distribution. So therefore, you're going to actually receive $90,000. But you do have the full intentions of putting the full $100,000 back into that IRA within 60 days. Now, because you didn't receive $100,000, you had the custodian withhold 10% of those funds. You only have $90,000 in your possession. So therefore, you're going to put $90,000 back into that traditional IRA. At this particular moment, because you did not put the full $100,000 back into that IRA, you will have to recognize income of $10,000. And if you're under the age of 59 and a half, you may also have to pay an early withdrawal penalty of 10% on that $10,000 as well. So which accounts will actually qualify under this rule? Well, as I've already discussed, traditional IRAs, of course, simple IRAs, SEP IRAs, and other qualified plans could fall under this 60-day rollover rule. So what exactly is a 60-day interest-free loan when it pertains to an IRA? Well, let's talk about the mechanics of this here. First of all, the IRS do not allow any account holders of an IRA to borrow funds from an IRA. So you can't technically take a loan on an IRA. You can do so in a 401k and perhaps in a 403b and other qualified retirement plans, but you cannot do this with an IRA. So the closest thing that you can do is quote unquote borrow money from an IRA and then withdraw those funds and redeposit it back into that IRA or another IRA within 60 days. So with that being said, it is very important that you understand that this is not a loan. It is simply a provision that will allow you to temporarily use funds from that IRA for your own use outside of that IRA for a little while. But that money does have to be paid back into that IRA, or as we mentioned, you will be taxed and perhaps penalized on those funds as well. Now, in this particular situation, that money comes directly to you. It's not a rollover. That money comes directly to you as an indirect rollover. So you will take possession of those funds. Now, you are only allowed to do a 60-day interest-free loan, quote unquote, from this IRA once a year or once in 12 months. So if you were to have taken this 60-day rollover option in July, you cannot do another 60-day rollover option until next July. So you have to go a full year before you can do this again. You can only do it once a year, and it's per taxpayer. So if you and your spouse wanted to do a 60-day rollover, both of you could actually do so. But just understand, it doesn't go within the year. So you can't do this in May and think that next January you can do another 60-day rollover. You have to wait until May in order to do another 60-day rollover from that IRA. Now, if it were not your intentions to take these funds directly into your hands or into your possession and actually have the onus on you to have those funds put back into an IRA to avoid any taxes or penalty, we would highly recommend that you do a trustee-to-trustee rollover. When you do a trustee-to-trustee rollover, those funds go directly from one trustee to the next trustee. So if you have money at JP Morgan Chase, that money will go directly to Charles Schwab if that's where you were rolling those funds over to, or Fidelity or Vanguard, whichever custodian that you were going to roll it over to. Those funds would not directly come to you. If they were to have sent those funds to you, the check would be made out to that custodian. So it would never be made out to you, as opposed to when you're doing an indirect rollover, those funds are going to come directly to your bank account, made out to you, however you're going to receive it, but it will be yours to cash in. It is also important to understand that there is no 60-day rule when it comes to a trustee-to-trustee rollover, or also better known as a direct rollover. You can do as many trustee-to-trustee rollovers as possible. So you can do a direct rollover in January. You can do another direct rollover in February. You can do another one in March. You can do one of these every single month if you had that many IRAs or that many rollovers that you wanted to do. There is no rule to how many of these you can do within any given year. And obviously, from my standpoint and my vantage point, it is much safer for someone who's going to be rolling over funds from an IRA to another IRA to do it this way here. It's going to be much safer, and you're definitely going to avoid any taxes or penalties on those dollars because you never take possession of it. And therefore, you never have to worry about putting those funds into another IRA within that 60-day time period. Thank you again for tuning in to our Tuesday tips. Please understand that these videos are created for educational purposes only, and that you should always seek out your own financial advisor, your own tax advisor, and your own attorney regarding your personal situation. Also, if you are looking for an independent fiduciary advisor to help you with these types of complex financial matters, we highly recommend that you utilize the links in our description below and go ahead and schedule a 1-hour free consultation with us today. And we would also like to hear from you. Tell us about your experience with doing any type of IRA rollovers. Let us know if you had any complications, or if you may have utilized the 60-day IRA rollover rules. And if you found this information to be beneficial, all that we ask is that you subscribe to this channel so it can continue to grow, like this video, and share it with others.